Looking back over the economics of the Russian oil upstream sector over the past 10 years, we see that despite considerable oil price volatility within two different price cycles, a tax maneuver, the imposition of foreign sanctions on the sector, and growing isolation, the Russian oil upstream industry has turned in a strong economic performance. Oil production grew by more than 1 million barrels a day, and by the end of 2019, the country has built up a spare production capacity of about 500,000 barrels a day, while it had none at the beginning of the decade. Sector profitability, in terms of cash flow in dollars per barrel, is now higher than 10 years ago, even though the global crude oil price is about $10 a barrel lower. Russian oil tax revenues in 2019 in US dollars will be at the same level as in 2010 and more than 2 times higher measured in rubles. Other positive developments include increased production complexity from enhanced technological capabilities and reduced dependency on important technologies, expertise and equipment. Russia started the decade producing at 10.1 million barrels a day of oil and condensate. Over the next 4 years, production was growing slowly at a rate of about 1% a year, until it jumped by almost 3% in 2016, reaching 10.95 million barrels a day, with a local peak of 11.2 million barrels a day in October, 1 month before the OPEC meeting. This level became a strong starting position for Russia's negotiation as part of the OPEC Plus agreement in terms of its contribution to proposed production cuts. In the first half of 2017, Russia gradually reduced its output by 300,000 barrels a day to comply with its 10.95 million barrel a day production target under the OPEC Plus agreement. The country held to this production level through May of 2018, when the Joint Ministerial Monitoring Committee decided to keep OPEC Plus production cuts on a group level, easing individual targets to offset supply drop from Venezuela and Iran. Russia was able to quickly catch this opportunity to bring production up by some 500,000 barrels a day, utilizing available spare capacity that had been accumulated during the time of the restraint, effectively becoming a swing producer for the first time. After this sharp production build, Russia negotiated production cuts in the subsequent rounds of negotiation from a higher level and for a smaller amount of only 228,000 barrels a day. Russia has had more difficulty holding the line to meet this target, and spare capacity again built up, reaching about 500,000 barrels a day by the end of the decade. The two common metrics that provide a view on general profitability of the upstream sector are average upstream EBITDA per barrel and indicative cash flow per barrel. While there is a difference between the two, they closely mirror each other, with a fairly constant difference of around $10 a barrel. Both indicators increased in 2010 with higher crude oil prices, but then fell sharply over the next few years despite high oil prices. They hit bottom in 2015-2017 and bounced back sharply in 2018. In fact, by the end of the decade, both indicators returned to higher level of 2010, even though crude oil price was about $10 a barrel lower. So why has Russian oil upstream become stronger economically, even though crude oil prices remain modest? Let's have a look at key variables involved and their interdependencies. Average annual cash flow per barrel is determined as net result of deducting from an average price of Urals major expenses, such as taxes, freight and insurance, crude oil pipeline transportation costs, operating costs, and capital expenditures. The first major element, taxes, comprises export duty and mineral resource extraction tax. While technically different and having very complex formulas, both are directly linked to crude oil price and are calculated in dollars. The higher the price, the higher the tax is in both absolute terms and as a share of the price. But at times of low prices, the reverse is true. For example, when crude oil was at $120 a barrel in 2011, government take approached about 80%, But when the price collapsed to $40 a barrel in late 2014, government tax dropped to about 40%. So, the government leaves producing companies with about $20 to $30 a barrel gross margin, regardless of the level of crude oil price. The second element of crude oil price decomposition is a set of expenditures comprising oil pipeline transportation costs, operating expenditures, and capital expenditures. The first two are close to 100% of local content, and capex is about 75% of local content. This means that industry costs decrease in dollars when the value of the ruble falls against the dollar and increase if ruble appreciates. This high share of local content protects producers' margin from falling too much at times of low crude oil prices, supported by ruble devaluation. Subject to a separate discussion, local content has been growing strongly and even accelerated in the last 3 years following imposition of US sector-related sanctions and the statewide import substitution program. Classic Dutch disease can be seen early in the decade, when high crude oil prices led to ruble appreciation, hurting not only other processing industries, but the oil industry itself. Strengthening of the ruble, coupled with domestic inflation, led to a 30% increase of oil-related expenditures in US dollars. Because the crude oil price was stable in 2011-2013, producers' margins were squeezed. But when the oil price collapsed in 2014 and hit bottom in 2015-2016, those expenditures also declined as the value of the ruble fell precipitously. The expenditures grew slightly in 2017 with an appreciating ruble until turning back again in 2018. A remarkable thing happened in 2018 when Russian upstream profitability jumped back to pre-crisis level, even though the oil price was only half of what it had been in 2014. The answer, surprisingly, is not the restoration of the oil price, but the new Russian budgetary rule and American sanctions. While the first factor broke the long-lasting relationship between the value of the ruble and crude oil price, providing a temporary cure for the Dutch disease, the second factor multiplied the effect, turning the medicine into a steroid. In normal circumstances, a higher price would raise the value of the ruble, leading to growth in industry costs. But in 2018, with about 30% increase in oil prices, the ruble lost about 15% of its value. This currency depreciation resulted in decrease in industry costs. Combined with the higher price, the gross margin jumped, so did the Russian upstream profitability. This effect continued into the March of 2019 until it almost vanished in the last months of the year. So, summing up the key points, we conclude that despite oil price fall in the second half of the decade, increased price volatility, US sanctions and growing business isolation, Russian upstream sector has become more profitable, oil production increased and significant spare capacity emerged. But will this momentum last long? See more on IHS Connect, Russian and Caspian Energy Service.